Wall Street is opening a new trading week with a hangover. The market sentiment depends on the looming crisis in the banking sector. Expectations of the Fed's policy decisions, news on a Credit Suisse, and soothing statements by regulators. Besides, the market is still affected by stubborn inflation and the recession threat. These pieces of the puzzle cannot fall into place. As a result, high volatility has settled in the stock market with the benchmark indexes trading on a roller coaster. The US stock market closed in the red on Friday amid the festering crisis in the banking sector. The three stock indexes closed with heavy weekly losses. No wonder the stocks of financial companies showed their worst performance. The Dow Jones lost 384 points or 1.19%. The Nasdaq sank by 0.74%. The S&P 500 shed 1.1% to close at 3,916. And the pre-market revealed that investors' nerves were on edge. The benchmark indexes traded lower in the midday, however, they inched up in the New York pre-market. Futures on the US stock indexes traded mixed, wavering between minus 0.5 and plus 0.5%. The S&P 500 is expected to trade in the corridor between 3,860 and 3,980 points. Friday was another gloomy day in the losing streak. The bank jitters escalated when Silicon Valley Bank announced that it would seek protection from a bankruptcy according to the Chapter 11. Concern over liquidity and the looming bank crisis aroused a painful response from the market. Shares of a First Republic Bank slumped by 32.8%. PacWest Bank Corporated tumbled by 19%. Western Alliance dropped by 15.1%. Credit Suisse shares traded in the US also closed with a sharp fall of 6.9%. In the last 2 weeks, the S&P Banking Index and the Regional Banking Index declined by 4.6% and 5.4% respectively. It's the worst 2-week drop since March 2020. All 11 sectors in the S&P 500 closed the week on the negative territory. On a Monday, futures on the US stock indexes traded mixed and quietly. Over the weekend, UBS decided to buy its alien rival Credit Suisse for $3.23 billion in a merger deal brokered by the Swiss authorities. Credit Suisse shares listed on US exchanges plummeted by 58.4% in the pre-market. UBS shares fell by 3.6% because the market shifted its focus to the blow delivered to some holders of Credit Suisse securities as a result of the merger. Nevertheless, futures on the US stock indexes rebounded from intraday lows. Hopes for less aggressive tightening by the US Fed supported the stocks of high-tech giants such as Apple and Microsoft. But optimism did not last for long. From now on, market participants expect the US Fed to put interest rates on hold. And still 39% of investors anticipate a rate hike by 25 basis points. Ahead of the Fed's policy meeting and the policy announcements on a Wednesday, the market is likely to trade cautiously. A lot of factors are in question today. Other major central banks acknowledged the risk of broader stress following the USB's merger deal. So, the Federal Reserve, the ECB and other central banks made statements on joint measures to soothe markets. The major central banks took such measures on a Sunday to provide cash injections around the world. The US Fed suggested standing US dollar liquidity swaps on a daily basis. This should guarantee that banks in Canada, the UK, Japan, Switzerland, and the Eurozone have enough dollars for their operations. With such measures, the monetary authorities underscored the gravity of the shock and its aftermath for lending capabilities, economic growth, and inflation. Some experts consider the Fed's lending via a discount window and liquidity provision to be a renewal of some quantitative easing. However, some banks, for example, Morgan Stanley, warned against such interpretation, saying that it would not interrupt monetary tightening and would not derail deposit cost growth. Large American banks such as JP Morgan, Citigroup, and Morgan Stanley dipped by 0.2 and 1.2% in the pre-market. First Republic Bank shares nosedived by 19.1%. Western Alliance shares slipped by 0.7%. At the same time, PacWest shares climbed by 6.3%. The economic calendar for the United States is empty today, and Fed's policymakers are not allowed to come up with their comments before a policy meeting. So, the main catalyst is in use on the banking sector, and the market sentiment is a mix today while the market is trading under high volatility. The likelihood of the Fed scaling down its monetary tightening landed a punch to the US dollar. Its index extended weakness on a Monday, having dipped below 103.70, and the index is trading at around 103.40 intraday and 0.25% lower. The intraday corridor for the instrument is defined between 102.90 and 103.90. The euro, the sterling, and the yen asserted strength, thus putting pressure on the greenback. Investors are downplaying the safe haven futures of the US dollar and focused on the Fed's pause in rate hikes. Fresh macroeconomic data does not assure the US Fed that inflation has been defeated. Consumer prices slowed down to 6% on a year in February. The CPI is 3 times as high as the Fed's target at 2%. Besides, there are no signs that the labor market is cooling down and wage growth is waning. Analysts suppose that the official funds rate will top 5% by the year end. Still, they reckon that the regulator will have to take a pause to blow out a fire in the banking sector. Indeed, further rate hikes at this stage might cause cracks in the financial system. The recession risk resurfaced again on the back of the shock in the banking sector, and the events in the last 2 weeks were a game changer for the Fed's monetary policy. The US dollar is expected to trade under pressure before the Fed's policy announcement. Nevertheless, the US dollar index will hardly decline below 103 points and could rebound to comfortable levels at around 104. The Canadian dollar is opening the week on an optimistic note. The USD CAD pair slipped by 0.31% intraday to trade at about 1.3680, and the instrument is expected to trade in the intraday corridor between 1.3620 and 1.3720. The loonie is taking advantage of the US dollar's weakness. Moreover, the loonie is trading confidently amid growth in commodity prices. At the same time, high volatility over oil prices prevents a steady rally of the Canadian dollar. Oil prices sank on a Monday to the lowest level in the last 15 months. Brent crude futures skidded by 2.8% to $70.90 a barrel. WTI futures decreased by 2.8% to trade at $64.86. Both benchmark rates won back some losses in the early hours of the New York session, and they tumbled by more than 10% last week. Oil prices came into a downward spiral amid the unfolding bank crisis, and the oil market is likely to trade with the higher volatility this week. The crypto market opened the week in confidence. Bitcoin jumped to the highest level in 9 months. Turbulence in conventional assets made investors turn attention to digital assets. As a result, Bitcoin touched the level of 28,567 on Monday and retreated from this high. Nevertheless, the token settled above 28,000. Altcoins are trading mixed. Ethereum pulled back from $1,800 to trade at $1,780. Last week was the most successful for cryptocurrencies in the 4 last years. Bitcoin appreciated by 26%, the strongest weekly growth since April 2019. Moreover, the token surged by almost 40% in 10 days. Such a stunning performance was driven by the bank crisis. The crypto market owes its strength to expectations in the Fed's monetary tightening. Analysts point out that Bitcoin can benefit from an injection liquidity in the global financial system. Looking back, the flagship crypto skyrocketed to a record $69,000 in November 2021 after central banks and government adopted unprecedented monetary and fiscal stimulus measures. As for the intraday outlook, Bitcoin is expected to trade in the corridor between 28,000 and 28,200. If the price failed to settle there, the token could sink to 26,900. The alternative scenario suggests that Bitcoin could grow to $29,100. Good luck in your trading and see you online tomorrow.